Well, hello, everyone. I'd like to welcome everyone to the seventh edition of our Big Questions and Land Management webinar. My name is Kyle Walker, and I am the Director of Land Management here at Peoples Company. I work out of our Indianola, Iowa office location and focus my time on improving our land management platform and service offerings for clients. Today, we will have four industry experts who will be discussing management topics, including renewable wind, solar, and battery discussion, land management services in the Delta, the use of fundamentals plus an algorithm for crop marketing, and using drones for application in agriculture. Hopefully you'll find this information useful when heading into planting season. I'd like to start by giving you all a brief overview of Peoples Company and the services we provide. Peoples Company has a national footprint with offices in all the major U.S. ag markets. Our offices are located in Walla Walla, Washington, San Diego, and Fresno, California, Tulsa, Oklahoma, Jonesboro, Arkansas, Arlington, Tennessee, Monroe, Louisiana, Centralia and Wentzville, Missouri, Marlette, Michigan, Omaha, Nebraska, and DeWitt, Indianola, Independence, and Clive, Iowa. We are a full service land transaction provider offering land management, land brokerage, valuations and appraisals, and investment services through our capital markets team and our newest divisions of energy management and crop insurance services. Our team has grown significantly over the years, and we have roughly 150 land professionals scattered throughout the country. Today, we're going to be focusing on topics relevant to the land management division. George Baird will be speaking specifically about the services we provide later in the presentation. I encourage everyone interested in learning more about Peoples Company to visit our website at www.peoplescompany.com. Before we begin, if you have any questions, please type them in a comment section below, and we'll try and answer them at the end of the webinar or throughout the webinar, depending on what the question is. Now, without further delay, let me introduce our first speaker, Brad Haight, who will be discussing renewable wind, solar, and battery. Brad is the owner of Farm First Energy and is a seasoned energy attorney and developer specializing in wind and solar projects since 2001. He's led the development of several notable wind projects, and currently he's involved in a 1,000-megawatt solar project in Colorado. His expertise spans legal representation, project management, lease negotiations, making him a trusted figure in advancing renewable energy initiatives. Hey, Brad, thanks for being with us today. First of all, we should be ready to start whenever you are.
Yeah, I'm ready. I think, Kathy, Kyle, you guys have my first slide. I'll let you start there, please.
We'll try and get it pulled up here.
Perfect. Yeah, great. Thanks. Thank you, Kyle. As Kyle mentioned, my name is Brad Haight. I'm a lawyer by training. I graduated law school in 1993, and I have spent the great majority of my career working in the energy sector. Next slide, please. As Kyle mentioned, I'm the founder and principal of Farm First Energy. We're an early stage wind solar battery project developer. I own and operate that with a partner based here in Denver with me, and we have a small team focused on meteorology, GIS, and development that works with us. I'm also founder, principal of a company called LeaseGen LLC. LeaseGen is solely focused on valuing the revenue stream off wind and solar projects. We, I guess, differentiate ourselves because myself and my partner, we've built, financed wind projects, solar projects, and our focus there is looking at the constraints, the problems, what differentiates one project, what may be a problem for a project, and then cause sort of a reduction in the revenue value associated with that project. And then probably more significantly, and this is the bread and butter, right? For me, I'm still a practicing lawyer. I spend about half my time practicing law. I represent a handful of owner operators of projects, developers of projects, And the rest of my time is spent working for institutional landowners, as well as typically larger farmers and larger ranchers. And that work is almost exclusively real estate. I will sometimes work on permits. I'll sometimes work on M&A transactions, but largely it's the core of the deal. It's the real estate. And boy, I sometimes surprise myself when I say it, but I've probably been involved in 2,500 different wind, solar, battery leases at this point over the 22, 23 years that I've been doing this, and it's crossed dozens and dozens of projects, gigawatts of build projects. One thing I do want to disclose, I have quite a few relationships with different companies, with different managers, and I will do my absolute best to always disclose, what I've done, what I'm doing to anybody that wants to call and ask me questions about any particular project, or what my views are may be on a particular project or a particular revenue structure. Next slide, please, Kathy. In 20 minutes, I thought a lot actually about what to talk about over the course of 20 minutes, because it's 20 years for me of learning what it is we do in this arena. And I thought that in 20 minutes time, probably the most valuable thing I could do is give you some advice based on what I've determined is the best way to think about these deals. And in my mind, it's a very rigid, stepped process. I think that if you're approached as a manager, let's say, with a project opportunity, and I'll just say hypothetically, it's a wind project opportunity. In my view, you can't make a considered decision unless you go through the first three steps of this process. I don't think you can make a considered decision about a lease and about how that affects the farm, how it affects farm value, unless you first understand what the asset is that somebody's trying to develop that involves your farm. And for me, understanding the project is largely about maps. I would say get as many maps as you can from the developer of what it is they're doing, what they're filing with the county, and put that on paper, and then overlay your own land on that map as well, and then overlay on that map where you are in relation to everybody else. It's interesting for me to see that sometimes there's more than one developer chasing a deal. We'll be in an area. I'm in an area in Washington right now, for instance, Washington State, and we've got two developers, right? Both credible stand-up outfits, both looking at the same land. We can look at the developer and evaluate the developer, vet them, vet their plan, and vet the money, and vet the lease, the non-economic parts of the lease. But if we sign with the wrong guy, there's no potential for us. Right? If we sign up with company A, but the land is surrounded by company B, it doesn't make any sense, and there's no point in us going forward. So for me, the step that you always start with is identifying and determining what the project really is, what it's about. The second step for me is the developer. Right? I mean, the turbine, the collapsed turbine to the right on this slide, I think, is an indication of what can happen. And this has happened. It's happened before. And this is a credible stand-up developer that this happened to, but it's happened to other credible stand-up developers as well. Positively, most of these guys have significant heft and they can take care of the problems. But sometimes the problems are more substantial, right? Sometimes the problems aren't collapsed turbines, but rather the problem is $10 million in cost to permit the project, right? If you're serious about a project, if you're serious about wind, let's say, and you want to see this thing advance, then let's please make sure you're with the guy that has the experience, the team, and the track record to get it done. And I'll spend a little more time talking about developers in just a moment. I think that the third step, and again, I'm rigid in how I look at these. I think the third step is looking at the project plan. And I think you need to ask questions about what it is that they intend to do. Granted, they're going to build a wind project. We understand that. That's great. Where are you going to inject the power from your wind project, and how are you going to get from point A to point B? Similar with solar. I looked at a solar project 2 weeks ago that made absolutely zero sense to me because it sits 10, 15 miles away from a line that's not even built yet. And it would be unbelievable to me to see that land used for solar in that market succeed. And so to me, that plan equals only an encumbrance, right? It's an encumbrance that sits on the land for 6, 8 years. Maybe you earn some option money, but the project to me doesn't go anywhere. And so I think it's important, right, certainly to evaluate the project plan, but only after you've evaluated sort of the project and the developer first. I will only go to the money and only the money after I've been through these first 3 points, because there's frankly no point in looking at how this benefits the farm financially if the project doesn't itself have legs. And so that's why we focus on the first 3 points first. And then if we've gotten through the first 3 points, then we look at the monetary elements of the deal. I know that's probably the most interesting to everybody, but frankly, there are so many variables between technologies, between regions, between states, between counties, between the different developers. It's a full day topic, right? It's a full day discussion. I am happy to get on the phone with anybody that wants to call and talk to you about what we're seeing and how the rates have sort of adjusted and how they're changing from market to market. And they are different. Illinois is different from Iowa, which is different from Nebraska, which is different from Colorado. So, just don't presume that because you're seeing, $30 an acre plus $6,000 a megawatt, using wind as an example in Illinois, that's going to apply in, for instance, Texas. Again, there are differences from market to market. I make it a point also, and lastly, of going only to the non-economic terms of the lease last. And that's because that's the hardest part to do. It takes the longest. If I was to talk to any one of you, that's a 2-day discussion, frankly, to work through all of the non-economic parts of the 50-page lease. And to be blunt, it's not worth the time, right? If we can't get through the first 4 points, let's please not talk about the non-economic elements of the lease, because again, that's quite a bit of effort for us to wade through. I think also, and if there are any wind solar developers on the call, they may hate me for saying this. I think if you jump right into the lease, you're making a mistake. And the reason is because it gives the impression that you're engaged, right? And once you create the impression that you're engaged in the process, they then presume they've got you, and they become a little bit less flexible. That's sort of secondary reason for putting the non-economic terms of the lease, the hardest part, last. Next slide, please. In terms of developers, there used to be a handful, right? When I first started doing this 20 years ago, there was Florida Power and Light, and that was it. That's in their current incarnation, that's NextEra. Presently, I would divide the developers into 3 categories with one sort of subcategory. The categories that I would identify are sort of the tier 1 guys, and the tier 1 guys I would break down into 2 groups. The tier 1A being the cream of the crop. These are the guys that have the biggest checkbooks, the biggest supply agreements, the strongest supply agreements, the biggest teams, and the cheapest capital. This is, for me, it's the NextEras of the world. They just have a great ability to get things done, and they do get things done. That's not to say that there aren't sort of tier 1B guys that aren't worth talking to, right? These are also owner operators of projects, but they don't own 150 projects. They own 5, they own 10. And quite frankly, I think they can do as good a job as the big boys as well. And sometimes they're actually a bit more nimble, right? You just may not see that they have the same long-term track record. The tier 2 guys, I would say, are the guys that the companies that aren't necessarily themselves going to own and operate a project. And I used to incorrectly presume that any developer that wasn't actually going to own wasn't worth talking to, and that was wrong. And I thought that way for 10 years. There are quite a number of what are called pure play developers, or I call them pure play developers, that are in this second tier that actually have an impressive track record of getting things done. They're awfully good at securing all the land, entitling the land, working through the interconnection process, and then getting the project ready to go. And when it's ready to go, then the tier 1A guys, the tier 1B guys, they're going to pick up that asset. And so I would not at this point forsake the tier 2 guys. Tier 3, 2 guys in a truck, right? And full disclosure, that's often me, right? Notwithstanding that, we're not going to take it to the finish line, right? And we're not going to own and operate it. There are groups like this that actually do a really good job. I think the devil's in the details with those relationships, though. And so just be, careful as and when you're looking at an opportunity like that. Next slide, please, Kathy. Because people ask, who do I like? Well, these are the guys that I like. The tier 1A, tier 1B guys, those are the IPPs. Obviously, NextEra, obviously, Invenergy. Pattern, I think, is great. Copenhagen Infrastructure Partners, DE Shaw, Scout, TriGlobal, Leeward, Apex, etc. These are the owner operators, and they all do a good job. The pure play guys, Hecate and Orion, are always the first 2 that come to mind for me. It's not just these 2 sort of categories, however, of developers that are chasing deals. In fact, I got a lease this morning from an institutional landowner that's being presented by Mid-American, and this is becoming more and more the trend. This being that the Mid-Americans, the Xcel Energies, the Alliance of the world, the utilities, they would much prefer to own these generating assets than to have to buy power from them. It's a difference between having an asset on your book or a liability on your books. And so don't be surprised if the opportunity that you're looking at isn't with a utility, a Mid-Am, an Xcel, or an Alliant. I would say and will say, notwithstanding that these are the good ones, these are the guys I like, every last one of them is imperfect. And every last one of them is going to make some unreasonable request of you, meaning that, I have issues with all of them too. What you need to do, I think, is the manager, is make sure that, the details work, right? And I would be sure to give the lease review the time that's required to make sure that what any of them are proposing are going to fit with the farm that you're managing. Next slide, please, Kathy. The guys I've struggled with, I don't want to name anybody specifically, but I do find myself generalizing, especially in a setting like this. And, one of the things that I've noticed, and again, these are my opinions only, but one of the things I've noticed is that sometimes the foreign developers are just a little bit less nimble, a little less flexible, and sometimes a little more difficult to get things done with. That's not always the case, for sure. Pattern is, essentially Canadian. Leeward is Canadian backed. CIP, that's, based in Denmark. It's not always the case that the foreign guys are bad. It's just a case that sometimes they may be a little too rigid, in their approach, a little less flexible than we need them to be. Yeah, Kathy, and I think that's my last slide, if I'm not mistaken. Yeah. Yeah, and I'll wait for questions at the end, correct?
That's correct.
Okay. I'll mute. Thank you.
Can everybody hear me now? Is that better as far as the audio?
Yes, it's much better.
Yes. Well, thank you, Brad. Everything seems to be moving so fast in the renewable world, and I appreciate your time helping us navigate all these opportunities. Next, we have George Baird, owner of Landmark Ag, and partner with People's Company. George grew up on a cotton farm in Sunflower County, Mississippi, with dreams of eventually becoming a farmer like his father and grandfather. His course changed and he graduated with a Bachelor of Science degree in Ag Economics from Mississippi State University in 1993. George is the founder of Landmark Ag Capital, located in Arlington, Tennessee, and has a wide range of clientele, including everyone from sole farm owners to large investment companies. George's proudest moment came in 2006 when he was selected as Farm Manager of the Year by Syngenta, Ag Professional Magazine, and the ASFMRA. George, whenever you're ready, you should be able to present.
Thank you, Kyle. Let's get this going. Can everybody see that?
Yes, we can see it.
Okay. Well, thanks, and thanks, Brad, for that kind of teeing me up there and giving the intro. I actually have some slides that kind of refer back to solar and wind because we're getting hit at like a lot of the managers across the PC platform around the country with opportunities for solar and wind. So like Kyle said, my name is George Baird with Landmark Ag. Today I'm going to run through a little bit about the land management and what all that includes, give a little bit of background, a little bit of information about my collaboration with People's Company, just a brief history or look into farm management in the Mid-South, as it's quite a lot newer profession here in the Mid-South than it is in the Midwest, per se. Also look at some of the scope of services we offer as professional farm managers, professional land managers in the business, and then look at lease structures and maybe talk a little bit about how lease structures might differ here than in the Midwest. Take a brief dive into land values and then kind of give you a few thoughts about outlook for the 2024 year. A little bit about my background. Like Kyle said, I graduated from Mississippi State December 93. Had actually didn't know anything about professional farm management, professional land management prior to my senior year of college. Everything I knew about farm management was, say, me working directly for the landowner, whether it was my grandfather, my father, somebody local. I had no concept or scope of people who own land, but that actually leased it out to others and what a professional land manager was. At that time, I was introduced to professional farm management during a summer internship in '93, and then began my career in January of 1993, which is kind of hard to believe when I look back, and it's been 30 years and looking forward to the 31st. Matter of fact, I was thinking the other day, it's just as exciting, if not more exciting now than it was 30 years ago, which has flown by. Co-founded Land Management Group in 2001, and then founded Landmark Ag Capital in 2021. And before I move to the next slide, this is kind of the map on the right is kind of the core area where I'm located here in the west part of Tennessee, and then manage property up and down the Mississippi River Delta. We have a real estate office, People's Company does, in Jonesboro, Arkansas, and then there's also a property management real estate office located in Monroe, Louisiana. This total area of the Delta combines roughly around 14 million acres of cropland. So I guess in scope, that's what roughly a little less than half the size of cropland in Iowa, but is a very rich and fertile part of agriculture across the U.S. A little bit about my collaboration with People's Company in September of 21. We formed a joint venture, and that expanded their management footprint through the Delta. They were looking to grow. I was looking for a team to partner with, and it just became a natural fit as we I guess, dated throughout the summer of that year, trying to figure out the best way forward. This allowed them to expand their platform, and then also gave me direct access to their best-in-class management service. And then also, I was able to begin working directly with their capital markets team, some of their real estate team, as they have clients that are looking to deploy capital into this Mid-South market. So it's been a very fun ride over the last few years, and look forward to continuing that going forth. Go over here. A little bit about the history of farm management. Professional farm management was introduced to the Midwest coming out of the Depression. Well, that was different in the Mid-South. We didn't really see professional farm management come to our market until really the farm crisis of the late 80s, when there was a lot of foreclosures. And in fact, probably the first 3 to 7 years, a big focus was put on liquidations, just cleaning up issues coming out of the farm crisis. Then moving forward, we begin to see more of a professional level farm management. But even in the early years, that was probably more so around the big shops like the Manulifes and Nuveen's and UBS's of the world. So that we knew about farm management in the Mid-South, but it was more from big institutional investors or cleaning up assets. It was only then when we began to see professional farm management become a little more known throughout, to individual landowners, private landowners. And that has continued to grow. I can tell you, 15, 20 years ago, if I went to talk to a new operator or landowner, they didn't have a clue what professional farm management was. And now it's more and more prevalent, and we're getting the word out there. So it's just really coming to be. I think a lot of that's because property was so tightly held, family held. I'm even seeing today where guys with lower commodity prices, they've been thinking about getting out for the last 2 or 3 years. They've decided to move out, and then some of the farm families that are kind of far removed anymore from this region, because they pursued other careers, all of a sudden they're going, who do I lease the farm to now? What are the rental rates? And that's where we can step in and really help. So we're there to provide, the next generation of landowners, an opportunity to retain their property. Maybe it's help them liquidate the property. Maybe it's do something else from a capital appreciation standpoint. So I think that's going to be a huge area of opportunity for us going forth, and I'm excited about. And there's also, as mentioned, we've had those longstanding institutional capital partners in our markets for years, but over the last 10 or 15 years, we've seen a tremendous growth and increase in institutional capital, not only in the Delta, but throughout the U.S., seeking to put capital to work. But I think that's even become more and more prevalent in the Mid-South as they're looking to aggregate acres. They can get in at a cheaper level. And then we have just a different level of opportunity for marketing crops. We have our traditional crops for the Delta like rice, cotton, corn, wheat, beans, but we also have some emerging crops like sweet potatoes, peanuts, and I think we're really ripe for development for vegetable crops longer term. When you look at our water resources, when you consider some of the issues they're having, East Coast, West Coast. So I think this is just going to be an area of continued growth that I'm really excited about. People's Company and has this 6-step process, and one that I've latched onto, and it's really where we focus on trying to understand the goals and objectives of the landowner. What's their short-term, long-term perspective? What's their history of the farm? Where are they going? And then come up and help develop a strategy that helps them meet their goals and objectives, whether that's an individual landowner who has no heirs and is looking to maybe leave it to a not-for-profit or something like that, or do they want to keep it in the farm as a legacy project for the family, or is it something they want to maybe liquidate and disperse funds to other family members or other institutions. After we can develop a strategy, then we can come back and propose 2 or 3 paths to get to that area. And then once we propose those, engage them, then we can execute that plan and then follow up with the results. And I stuck this in a circle because this is not a one-time process like many of the things that we do. This is an ongoing project, ongoing circle year after year, because families change, dynamics change, you know, people's ultimate goals and objectives change over time. A little bit about our scope of services, and this is just a few of the items that we get into. It goes on and on. And what I like to say is that we have a system that can be custom for any farm management client, you know, whether it's institutional investor, individual family, individual landowner, multifamily. We can develop and cater our services to meet what they want. You know, a few of those are just lease implementation and analysis, you know, managing the USDA programs, identifying capital improvement projects. That's something we get into a lot of in the Mid-South. You know, maybe we take a 500-acre soybean farm, and maybe it's not primarily soybean, and one, you know, 130-acre pivot, and we implement a development project, develop it, level it, provide irrigation to it, and next thing we've taken an asset that's going to average, you know, $150 to $175 an acre and bump that up to $250 to $300 an acre by introducing a more aggressive crop mix like rice or cotton or corn, and even with beans, having now that farm being irrigated. So looking at what kind of capital improvements that we can implement, and a lot of that, of course, will be based on the owner's goals and objectives. Are they looking to exit in 35 years? Are they looking to keep this long term? Is it to pass on to the family? You know, like I mentioned, with capital improvements, then you can begin setting up your crop plan or develop a marketing plan. And that's where working with John and his team recently has really become helpful with us at People's Company and our relationship there. You know, farm operator selection is key to making all this work together. You know, if I'm not there as a land manager to babysit that farmer, but I'm there to work side by side and look after the owner's best interest in everything he does. You know, a lot of, you know, we hear all the time also about analytics and information and data. This is a data-driven world. And anytime we can gather yield maps, you know, plant dates, you know, seeding rates, new seed varieties, get all the data we can, that also provides us, you know, real-time information we can use to make decisions, but also creates that wealth of knowledge or that book of knowledge that we can transfer with that asset down the road should they get ready to liquidate or sell it. If you had a long time, if you had 25 years of history that proves, you know, that you have certain yield trends, you know, certain returns, that farm is going to be much more valuable than a farm that has zero or little information that you can provide as part of that package. You know, one thing we always focus on, assuming that's what the client wants, is asset preservation, right? You know, not only are we increasing income, but we're preserving that asset and making sure it's also sustainable. You know, whether it's conserving our water, it's through our practices, it's implementing new conservation practices. You know, where there's always timely and consistent reporting to the landowners. We're just coming off of our, you know, finishing up our 2023 end of year reports and jumping right into our 2024 business plans and providing kind of a recap of everything that happened, and then really doing a deep dive looking forward, you know, commodity markets, cropping plans, you know, any capital improvement projects, laying out a budget, you know, annual budget as well as a quarterly budget, and really making sure we provide the landowner a clear snapshot of each and everything that's going to happen on that farm in the coming year. You know, speaking to lease structures a little bit, you can see in this chart, it kind of provides, you know, a risk assessment, you know, from the lease risk, which is cash rent, up to direct operation, which is, you know, all in where the landowner pays for a lot of the expenses. I tend to live most of my time in number 3 and 4, where I'm doing crop share leases, or in a growing area, minimum cash or share leases, whichever is greater. I would say probably over my last 30 years, 90%, 85 to 90% of my farms have always been a share-based farm lease. You know, I always like to say, you know, if a farm operator makes 1,200, he doesn't mind giving you 3, but if he makes 6, he can't give you 2. And so on the share basis, we can grow that farm together. Because lot of landowners, especially if maybe they're older or if there's some AGI limitations, can't take any government payments. We started putting in these minimum cash share arrangements where we get a minimum guaranteed on the front end or split it, but then we participate in the upside of the farm. That's a little bit different than maybe a flex lease like you'll see in the Midwest, where there's a share percentage over a certain gross income. And I tend to go to this method because it's hard for us to quantify the exact cost when you might have to irrigate. You know, are you going to irrigate your corn 3 times or 9 times? Do you have to spray it 2 or 3 times? Or we have milder winters, more insects, more weeds, more weather variability. So we tend to kind of do this minimum cash or share. I think this year, over 25,000 acres, 39 leases, I will have 2 cash rents that total 700 acres in scope. But this tends to be, you know, great opportunity, especially over the last few years. We've seen really good yields and good prices on rice, cotton, corn, and even beans. But we've been able to pick up some significant upside, well above what even would be considered higher cash rents for our market area. Move forward pretty quick. You know, one thing that's exciting when you're working with somebody like People's Company is kind of their online platform and technology and tools. They've just rolled out internally a farmware system that allows all the different divisions, as you can see on the right: appraisal, brokerage, capital markets, energy management, and crop insurance, to work in sync together. So if I'm managing a farm that's right next to somebody's farm that's been appraised, you know, we can collaborate and talk, or maybe, you know, energy management is working with somebody on the solar site that's 2 miles from a farm that we manage, and maybe there's opportunity there. So it's cross-referenced. There's going to be continued future rollouts for the managers and the tools, and eventually we'll see this go to a client interface, which will be pretty exciting. Quick dive into land base. I'm not going to spend a lot of time here, but would welcome the opportunity to visit with anybody beyond this call. You know, 2023 and actually the last several years was just a sheer imbalance of supply and demand. Tremendous demand out there, a lot of cash buyers sitting on the side, but very little supply on the market. And even what was sold, a lot of that was off market. Our market tends to be completely different than the Midwest, where a lot of it goes without going to auction, without going to private sale. And so it tends to be a little bit tougher. I think looking ahead, though, we're going to see a lot of family transitions and opportunities to buy land, and we're going to see some portfolio sales, meaning where some of these institutional partners brought capital to the market 10 to 15 years ago with mandates of a 10 to 15 year hold, and now they're starting to come up on those timelines. And so we're going to see some of those change hands. In fact, I can count at least 3 just offhand, thinking about 3 different portfolio sales that have taken place over the last 12 to 15 months. And I think that's going to become more prevalent. So that's going to create a lot of opportunity for additional capital, especially this large capital coming in, as well as some landowners that maybe are looking to get out, and some of the big institutional partners want to acquire more properties. Brad talked about this a little bit. You know, outside influences, solar, wind, recreational leases, carbon credits. I've done a lot. Well, I've had a lot of discussions. I should say I had done a lot. Had a lot of discussions, especially on the solar. The wind thing has really picked up over the last 3 to 6 months across the Delta. You know, recreational leases have always been here, but they've continued to move higher. And something we haven't delved into much, but are continuing to monitor carbon credits. You know, I can tell you I know 3 deals too that I was intimately involved with last year that would have gone to properties my clients were buying that would have happened, except for the fact that at some point prior to us getting through the purchase agreement and everything, a solar company inadvertently, you know, they do it on purpose. They went to a family member that we were talking to, and because of the opportunity that they saw of the big money out in the future, it killed the whole deal for us, which is understandable. You want to explore that, but you know, we didn't have the luxury sitting around waiting for them to vet that out. We had to move forward. So it's going to create some interesting dynamics. The land trends continue to move higher, like we've seen across the country. This is USDA data that don't really look at the numbers, but just look at the trends. It's continued up. Matter of fact, if you look back over the last, I think it's 45 years, the average appreciation for like Arkansas is 5.4%. And it's continued to move higher. We kind of flatlined, 6 to 7 years ago for about 3 or 4 years. And over the last 2 years have seen that continue to boost. Last year, they said we were down in the 3 to 4% range. I think actually that was closer to that 6 to 7% range. Wrapping up here, would I see 2024? We're sitting in a perfect spot for a great jump for 24. We had a great harvest. A lot of land preparation work was already taking place, and people are just chomping at the bits to go in that. And actually, with this above average temperature we've seen, we're trying to hold them back before they go too quick. But there's some guys ready to go. I think you'll see tractors, planters hit the field in full force across central Louisiana over the next 2 weeks, and then continue to move north. I think we'll see interest rates moderate slightly. I think we're going to see increased land opportunities. I made the comment just last week. I've seen more opportunity for land moving in the last 3 weeks and been part of those than I have all last year. So I think that's going to be promising. I think cropland A, meaning irrigated precision level land, is going to hold its own and maybe even up 3 to 5%, whereas cropland B, irrigated but not leveled, or cropland C, dry land, I think that's where we're going to see some prices soften, because the cost of capital improvements, cost to develop land, and the time it takes is a little prohibitive if you don't have that long-term horizon. So really excited about the coming year and looking forward to getting going over the next few weeks. Here's a quick recap of the map that Kyle shared. And I did stick a dot down here in the far southeast part of the United States, where Thiago Lima just joined in the Jacksonville, Florida. Is going to be handling Florida, Alabama, Georgia for People's Company, and enjoyed working with him in the recent weeks. And here's my contact information bio. Would welcome the opportunity to put anybody in the truck and let's ride around, explore the Delta, and see what we can get into. But thanks, Kyle, for time, and look forward to answering any questions.
Thanks, George. Can you nod? Can everybody hear me? So we're still running into difficulties. I just want to make sure. Okay. Really appreciate it. Yeah. If anybody has an interest in going down to the Delta and riding around with George, it's definitely worth a visit. Seeing cotton, rice, for an Iowa kid that doesn't see that very often, it's a beautiful place to visit. So, with that, we really appreciate your expertise, George, and the ongoing partnership with People's Company. So our next speaker really needs no introduction in the ag industry. John Roach grew up on a family farm near Carlisle, Iowa. He began his career in grain marketing in 1973 and founded Roach Ag Marketing in Perry, Iowa in 1978. For the last 45 years, John has dedicated his career to helping farmers improve their business practices in areas of crop marketing, hedging, retirement savings, and tax planning. Thousands of farmers rely on Roach's Ag daily grain plan and sell signals as a commodity component in key marketing crop strategies. With that, John, it's so nice to have you here today. Thanks for joining us, and we should be ready whenever you are.
Thanks, Kyle. I appreciate it. I'm going to see if this will work the way it should. Okay, I think I'm working. You can see the disclaimer popping up. Okay, so I'm working. Thank you very much, Kyle. I appreciate being on the program this afternoon. George and Brad are top-notch people. My gosh, it's nice to be in their company, and I'm learning a lot. I'm going to talk today about feed grain fundamentals and really fundamentals of all the ag markets, the crop markets, and the fundamentals. When we start looking, we start to worry a little bit about how they help us with marketing. I'm going to pull up I apologize for all these numbers. It's really hard to look at this sometimes, but this is the February WASDE report that came out February 8th, and it shows the January estimates and the February estimates for the world coarse grain or feed grain production. And you can see the production in February is estimated at 1.510 billion bushels with an ending stocks of 348 million. Those are numbers that probably don't mean much to people. So the first thing I did is go back and look at, well, what were they saying in June? And so I've just pulled up, oh, by the way, after this report came out on the 8th, the corn market closed that day at 4.33 and then went on down to below $4. So everybody looked at these numbers and said, these numbers are bearish. These are problems out into the future. The fundamentals are no good. But when I pull the June report up, you'll see this is June 23. Notice the production estimate. It's 1,513,000,000 and the ending stocks is 340. Let me go back. You see the difference. You see, basically what they're telling us in February is exactly what they told us in June. And so when people say the fundamentals have really turned bad in the grain market, well, they actually turned bad some time ago. And when we got them in June, notice that the corn price closed at 604 that day and rallied on up to 672. Now, why is it the same set of fundamentals have a $2 plus difference in price value? Well, as you remember, last June, we were worried about the U.S. crop production. Right now, we're not worried about U.S. crop production. It's too soon. The seed is still in the bag. It's not much to worry about yet. Last year, we had the Brazilian crop that was reduced. Well, we had the Brazilian crop reduced again this year, but we're not yet, we don't know those numbers yet. And that's one of the things here that when we look at these, put this into a graphic form, now you can see this forecast, and this is for the end of the 23-24 crop year, the red bar on the right-hand side. And you can see it's a little bigger than the last 3 years. But it's not a drastic big number, but it's definitely an increase. So whenever you're increasing carryovers, by definition, that's bearish in the fundamentals. One of the things that's not being really talked about too much when we look at these numbers is that the government forecast for South American corn production on this February report was 186.6 million tons. And the private estimates, this happens to be Dr. Cordonier's worksheet, and his estimate's at 173. So already the government estimate, which gave us this graphic, is too big of a stocks number because we know the Brazilian crop is not that big. And the other thing we know is that the Brazilian crop is just being planted. So it's just entering really its risk period of time for the majority of the crop. It's a second crop. And so this 173 number is a moving target. And you'll notice that the minimum, Dr. Cordonnier said, it could go as bad as 160. Or maybe if the weather's good, it could be as big as 180. So the point here is that the news we saw in the fundamentals is not only old news, it's ignoring some of the problems that happen in South America. Now, if we shift over and talk about the United States, look at the supply-demand estimates. Again, I'm sorry about all these numbers here, but that's the May estimate, the June, the July, et cetera, and a vertical column. And come down to the bottom, when we talk about prices, stocks-to-use ratio is the way that we compare month by month, because the usage changed, the inventory changes, and so we divide it out. But if you'll notice, the stocks to use ratio was 15% in June, or sorry, in May, 16% in June, and then you can see it go all the way across. It basically has been the same number since back in May. Now, one of the things that definitely has worried people when we saw the outlook form over on the right-hand side in the yellow. Now, this is their, this is not the WASDE report. This is what the economists put together before they make a big presentation to everybody what the new year looks like. And what you see is they're estimating corn plantings at 91, which is down 3.6 million acres compared to this past year. They're estimating yields at 181, which is above this past harvest of 177.3. So what they're giving us is they're giving us big kind of numbers. Now, interesting, go all the way over to the left and look at the May estimate. And what you see is they basically are giving us the same number they gave us last May. So although these look like big numbers and problem, and I'm not going to, I don't want to take away from it, they're old numbers. This carryover number, by the way, is at a 17% stocks to use ratio. So you can see that that is definitely bigger than what we're going to experience this fall. That's how it looks on a graph. This is next year's crop. The crop you're going to plant in the spring is in the red bar, and then this bar is what the stocks should be. This is their estimate of what the stocks to usage ratio will be at just before harvest of 25. And that is a big number. Soybean fundamentals are similar. Notice that the production in February was 398 million tons with ending stocks of 116 and a price of 11.93. Now go back to June and it's 410 and 123. Now look at that. 410 is bigger than 398. And the ending stocks in June at 123 is bigger than 116. So from a fundamental standpoint, the numbers they gave us here on the February 8th are better numbers than they gave us back last June. And again, we had weather problems. We can understand the difference, but we're in a period of time when we don't have any weather problems because the seed's still in the bag. And so we know that that will change when you put the seed in the ground. That's when you can start to have risk. That's when people will start to worry if we miss rains and so forth. And look at that price, by the way. July beans closed at closed out 13.86 following the June report and peaked just a short time later at $16 a bushel. And look at what the government was putting out at that time was ending stocks. That'd be the second bar from the right, the green bar. That's the stocks number for the crop that's in the bin, with the red bar being the crop that you're about ready to plant. Looking at the South America situation, it's similar. The USDA is at 222 million tons. Private estimates are at 211. And you can see that there's a possibility that those numbers can slide even further. They're still harvesting soybeans. They're about halfway through their harvest. If you look at the supply demand estimates going back to May, you'll see the same kind of pattern. The stocks to use ratio was 8%. Then it went to 7, down to 6, down to 5, back up to 6, back up to 7, back up to 8. So we're right back where we started in May. Look at what the government forecast was for the price in May. It was 12.10. And yet the price right after that report came out was at 13, went up to 16. And the government's price is estimating 12.10. Farmers didn't pay any attention to the government's estimate because they were worried about crop in the field and they were more optimistic. And as it's turned out, the government price estimate was more in line than where the market was at that time. You look at the forecast from the Ag Forum, they're talking about 87.5 million acres planted. That would be up almost 4 million acres, 3.9 million acres with a yield of 52. Now come over to the far left and you'll see the same situation. The production estimates that they gave us back in May, that's about what they gave us here in February in the Outlook Forum. But when we get through the usage, which is definitely being pulled down, we end up with a stocks to use ratio of 9.89 compared to today at 8. It's bigger, but it's not a huge number, but it's definitely bigger. And so I can't be real positive on the fundamentals right at the moment unless the weather starts to give me some reason to get positive. Here's how that looks, the stocks to use ratio on a graph. You can see it's bigger than the last 3 or 4 years, but it's not the huge numbers that we've seen in the past. Wheat fundamentals are the only ones that we're seeing smaller stocks as a percentage of usage. So the big picture in the world, we could have a positive wheat market here this year. I'm not going to go through the supply demand, just let's look at the stocks to use ratio. Even though we're talking about the world having tighter stocks, the United States is going to have bigger stocks according to the most recent forecast. And again, that's the 24-25 crop. So the crop that's in the bin is the second bar from the right. which is still, I'd say, a relatively a tight situation. If we have any kind of weather problem on the crop in the field, it's going to make a difference to the market. If you've looked at these numbers and been frustrated, you're like all the other farmers out there that we talk to. When we get the high prices, we're worried about weather. It's hard to sell. People don't really have a plan to sell. They look at the fundamentals and they think that they're understanding the fundamentals. But as you can see from just looking through here, the fundamentals don't always give you the path to the future. We use a price algorithm to convert the normal price cycles into a Roach Ag sell signal. We publish our daily grain plan. It goes out to about 12,000 people, and we train farmers on how to use our sell signals. This algorithm was actually started by a guy by the name of George Lane back in the mid-50s, and it's frequently referred to as slow stochastics, which is a real early algorithm, and we've been using it. We started using it when I was in Perry, and I moved here to Florida in 2000. So we started sometime in the 90s. So we've been using it through strong markets, weak markets, sideways market, all kinds of markets, record highs and disappointing lows. And so we have some confidence in it. So let me explain how that works. As I said, we use an algorithm. We call it the sell signal. We then add three more things. We add seasonality, the cash price versus the forecast. And remember, we just talked about on beans. The government had a price forecast down in the 12s, and the market was in the much higher prices than that. And so those boxes get checked when that happens. And then the last is the money flow. This is a picture of the graph we put out to our subscribers whenever we have a sell signal. So we go back and we look at history. If you look at the lower 1/4 of that graph, you'll see a red and a blue line with some green boxes. Whenever those red and blue line, the two of them get above 75, that triggers a sell signal. And so you can see we put a box around the one on the left that occurred in June. The sell signal was triggered with just a little bit of an up in the market because we had quite a big down. And so it was triggered on June 8th. You can see that we increased sales. We didn't do it initially because we'd already made sales at higher prices earlier. And so we were able to be patient a little bit, and we're able to get some sales made kind of in the middle of those green highlighted daily price moves. The way we did this to illustrate it is that we took the days that we had a sell signal and we colored them in green. So you can see each day that we were in a sell signal, and it lasted for several days. And then we moved higher again and triggered another sell signal. We triggered a third box. And so you can see where we made sales. And by the way, I want you to look at where we made sales and where the high of the year was. We're consistently making sales on highs. You'll notice over on the right-hand side, when you have a big market decline since November, we don't have any sell signals. Had we been really smart in November, instead of selling half of the beans, we would have sold all the beans and the neighbor's beans. But remember, we had a weather concern going on in Brazil, and so there was some reason to wait. So this is how our sell signal lays out. And the second thing we look at is a seasonality. This is really pretty simple. It's that each of those yellow boxes is either the high month for the year or the second high month, and the year goes horizontal. And so if you look at the months of April, May, June, and July, there's a lot more yellow boxes, and a lot of those yellow boxes have the red printing, which means it was the high month. And so we think that when we get during the time frame of April through July, that's the time when we get our better prices, and so we will sell more grain. It checks another box, and we sell more when the seasonality says to do that. Soybeans, we had to add in January and February because of the crops being raised in South America, but we still have the U.S. crops This may seem like it's kind of a simplified thing to look at, but I can tell you it really makes decisions a lot better because it just reinforces you're doing something at the right time of the year. And you can see wheat has quite a few different times. It's a little harder to see that. The third thing we look at is what's the cash price versus what the USDA is forecasting. And if we're above the USDA price forecast in the cash market, it may not just a little above, but we're enough above it makes a difference to us, then we trigger the third key market indicator of price versus forecast. And here's the current forecast: corn 480, beans 1265, and wheat at 720. So if we're looking at cash markets that are well above that, that triggers the cash price versus forecast. And then the last one is money flow. We think this is maybe the most important thing. What caused the market to go from the prices in June to the prices today if the fundamentals were basically the same? And this is what causes the change right here. Here's managed money in a tabular format. And on the left-hand column, you can see corn, and you see the report date of November 3rd, 23. That's a Friday, and it measures the position of the traders, the big traders, as of the prior Tuesday. So when you get the number on Friday, it was good on Tuesday, and that's changed Wednesday, Thursday, and Friday. But you'll notice on corn, they were short 144,000 contracts. On beans, they were long 23,000 contracts. Notice on beans that they were long 23, they went up to 68. That's 45,000 contracts in a week. And then they put on another 19,000 contracts in the following week. And then they started taking the positions off. You can see how they go from long 87,000 to being short on the 5th of January of 11,000. You can see the same situation in corn. Last week, they added 26,000 contracts to corn. And to kind of put that into some perspective, the total corn export forecast is 2.1 billion bushels. That totals out to 8,000 contracts. So if we had an average week of export sales, it was 8,000 contracts, and compare that to the spec funds that sold 26,000. Spec funds are much bigger most weeks, and they really drive the market more than what maybe people think. Here's the managed money, the spec funds going back to January of 14, and across the center you'll see a zero here on the left-hand side. That's when they have no position long or short. Their long positions offset their short positions, so they'd be at zero. And you'll notice here in 2014, January of 2014, they went from short 100,000 to long 275,000, and they did that in a period of about 3 months. And then in the next couple 3 months, they liquidated their position back down to under 100, build it back up again, and then they peeled out from over 200,000. They went down to short something around 120,000. Notice how fast and how far they changed their positions. And these were the record positions, long positions. And when we came into the 20s, you can see in the first half of 21, they went to a record net long position of 400,000 contracts. Then they started to liquidate, then they build it back up again, and they peaked that build sometime in about May of 22. And from May of 22, you can see what the funds have been doing. This is what's caused our market to decline. We've had this kind of selling activity going on, and now they hold a record short position. So all the power you saw when they held a record long position, you see weakness now that they're holding a record short position. Now, as you look on that graph, there's only three things they could do. One, they could add more shorts going into a growing season. Doesn't make a lot of sense. They could stay with the shorts they have and just be patient. And you see that across on some bottoms here. That's happened a few times, but typically they're not very patient. They go from short right back up. They start covering shorts, and they end up going to the long side of the market if they get enough stimulation. The key to remembering this, understanding this, is to understand they are trend followers. If the trend is up, they're long. If the trend is down, they're short. And we find the 20-day moving average being a good, reliable indicator of what the direction of the market is. If the price is over the 20-day moving average, you can expect the funds to be buyers. And if it's under, you can expect them to be sellers. Here's soybeans. You see the same kind of a pattern. They didn't get short at all from July of 20 up until 23. And then in early 24, they moved into the short position and they rapidly built a very large short position. Here's wheat. Now, wheat's interesting in that they quit selling. Notice this here. They quit selling and started to cover shorts. And the wheat market today came up and banged off the 20-day moving average and got turned back. But they're banging on the 20-day moving average, and you're banging on turning these funds into buyers. Wheat could have a nice run in here. We're telling people to get ready. We should get an opportunity to make some sales in wheat. But we'll have, again, we have to maintain the upward trend, and we haven't quite got it started yet. There's Kansas City. They're still on the short side there. There's Minneapolis. Maybe they're doing some turning around. When we get all four of these indicators triggered, that's when we feel most confident in our sales. So let's just look at how we've done. I'm going to run through fast, but I want you to look at where the green blobs are and where the price is. And you can see we had 3-box sell. This is 21 corn, 3-box sell, and it starts in the September 1st for the crop year and ends in August 31. We had 3-box sell signals, and then they triggered into 4-box sell signals, and the high of the year was made during one of our sell signals. There's 22. You can see the similar kind of a pattern. We had 3 boxes, then we triggered the 4s. And the high of the year was made during one of our sell signals. In 23, the high of the year was made during one of our sell signals. We never got a 3-box. We never got a 4-box. We had to sell on 1 boxes and 2 boxes. And here's the May 24, and you can see where we made our sales here earlier on in the year, and then we stopped in October, and that was a mistake because the market just slid right on down. We stopped because we were concerned about the Brazilian dry conditions and the reduction in acreage down there on corn in their second crop, and we'll see. We'll see in May, June whether or not we made a really stupid mistake or just a minor mistake, or maybe we're still okay. But we're not selling corn down here. We're just not going to sell any corn down here. This is like punting on the 3rd down. February is not the weather worry of the crop year. It is in South America, but it isn't in North America. Soybeans, you'll see a similar pattern where we're selling on rallies and we were selling on the peak. And another in 22 had a pretty good run up there, long sell signals. These get frustrating sometimes because they're long sell signals and people go, well, geez, I sold yesterday and it's 30 cents higher again today and blah, 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 blah. Okay, but look at the price. We were selling $15, $16, and $17 beans. Okay, so, and again, we were selling at the highs. If you look at the 23 beans, here's where we are. And we sold into the summer months pretty good. And here's the 24, and you can see we brought our sales up to 50% sold minimum back in November. And again, we should have sold all of them plus the neighbors. There's November of 24, where we've got some sales off. Here's wheat sales. I'm running out of time, so I just want to give you an idea of how our system works. And you can see what we do is we sell highs. Here's our 23 rice chart. There's the current March rice chart, and we focused in on getting sales made here in these last 2 sell signals on the right-hand side. Here's cotton for 23, and we got a huge sell signal here on cotton. If you're needing to sell cotton, you need to be selling cotton here. I know everybody's bullish, but that's the time when you need to get your sales made. And so if you would like to take a look at what we do, go to dailygrainplan.com, and we have a 30-day free subscription, or give us a call. We'll be happy to answer any questions that you might have. And that's the end of my presentation. Thank you very much.
All right. Thank you, John. That was great. Very complex subject. I'm surprised you don't have a few questions in the comments below. People's Company, we appreciate receiving your sell signals and to enhance our marketing strategies. Just wish these markets would go in the opposite direction than what they're doing right now. So With that, our last speaker will be Danny Assman. He'll be presenting on Terraplex Ag and the use of drones in agriculture. Danny is from Erling, Iowa, where he resides on the family farm with his wife and 2 boys. After earning his degree in animal science from Iowa State, he spent 14 years as a commodity trader before transitioning back to farming 6 years ago. 2 years ago, he launched Terraplex Ag, focusing on drone technology for agriculture. Danny is passionate about the drone industry for its significant impact across the supply chain, including farmers, applicators, ag chemical companies, landowners, and non-farming neighbors. Danny, are you ready to go, or is Kathy got your slides, or are you handling them?
I've got them. I am ready to go. Can you guys all see my screen?
Yes.
So today I'm here to talk about control and using drones for application. Can't control the weather, can't control the market. We up until this point, we couldn't control our aerial application. Everybody's heard about using drones in agriculture. Whether that's imaging drones or spray drones or thermal drones for cattle, I'm here to tell you in 4 key points why drones are revolutionizing farming and how they're changing the family farm. I'm also going to tell you why, shameless plug, right? Why Terraplex is investing in drone sales and service. As Kyle said, my name is Danny Assman. I'm a farmer in Erling, Iowa. For those of you that aren't familiar, that is the Luss Hills. We do not have the best soil, but I would argue that we have some of the deepest soil. I spent 15 years after graduating from Iowa State as a commodity trader and then a consultant. Been farming with my dad for, 6 or 7 years now. And family farm. I live on our family farm and live with my wife and 2 kids. And we got into the drone industry, honestly, on accident. Partner in mine, Ryan Schrader from Odebolt, Iowa, started a company called Iowa Aerial Applicators. Saw a spray drone at the Sioux Falls Farm Show and thought it was pretty cool and kind of made an impulse buy and turned out, I guess, pretty okay. We changed the name because we are doing so much with sales and service to Terraplex Ag in the fall of 2023. So it's been quite the ride and watching the changing of the ag drones and how they're changing farming. Everything from thermal drones to check livestock and even look at temperatures inside of canopies of corn. Had a customer ask about that the other day. To spraying and applying products to our fields, drones are helping so much, make the world so much more efficient. The best part about these drones is, they can be made in any sort of you can spray in any type of condition. As long as it's not wet, you can spray. They perform really well in all types of terrain. I'm in the Luss Hills in western Iowa. We've got 20-foot terraces that are holding high flats, but the corn will make 250. So you gotta take the good with the bad, but it's a challenge for a plane or even a helicopter pilot to do a good job. There's some advantages we'll get into later with the smaller payload tank size. A lot of people think it's a disadvantage. I could argue either way. And this is really important. I think the lower barrier to entry, and I believe that drones are a big part of the decentralization of production agriculture. What that means is that it puts me farming 600 acres on a very level playing field with a guy farming 6,000. And they also, because of the lower barrier to entry and the technology advantage, they're a great way to bring the next generation back to the family farm. A hog building takes, I just looked into this, 15 years to quote unquote pay off if you want to work really hard and not have, basically own the building when you're done. A drone can pay for itself in 1 year. The biggest thing and the advantage for the farmer is the versatility and control of application of timing. There are, John, how many million acres of corn were planted in the US last year? Was it 92, 94, somewhere in there? Yeah. And, with the new diseases that are coming on, more and more of the higher yielding corn, more and more acres are getting sprayed with fungicide, foliars, biologicals, and with the lower prices, we can control, and anything we can do, we can't make the corn worth more, but hopefully we can make more corn. They're again bringing the younger generation back to the family farm. Great supplemental income to a 20 or 22-year-old kid coming out of high school or college who wants to farm, but the family farm's not big enough. Great side hustle, so to speak. We're just at the beginning of what spray drones and drones in general in agriculture can do, whether that's the LiDAR drones to get pick up rocks. There's companies that specialize in identifying rocks in fields to pick up rocks, or the NDVI drones to check on your plant health, to the spray drones. In the next 1.5 to 3 years, because of some of the diseases such as tar spot that are coming, and just simply put, the retirement of a lot of the aerial applicators, we don't think drones are necessarily replacing anything. They're just coming in as supplemental spray equipment. So now I want to talk about the fun part, which is what's good about drones. Control of timing eliminates the reliance of third-party vendors. Basically, you're not relying, aerial application is the last thing that the producer hasn't been able to do up until this point on his own. Today with drones, now they can change that. We can spray the crops when they need to be sprayed. And, once we've reduced the cost of application and that drone's already paid for, the ROI goes even higher as you're putting more and more passes on. It just cheapens up your cost of application. You'll start doing more and farms will start producing more. Biologicals and foliar feeds, which are a ton of fun. I tried 4 different foliar feeds on one of my farms last year. 2 of them worked. One of them worked really good. Much like everyone else on here, we don't sell products, so I won't name names. But if anyone has any questions, you're more than welcome to ask. But there's nothing scientific. It's just what works on my farm. But the whole point is that drone allowed me the ability to do that. So it's really early, and Bex did some research and they had some PFR data that I'm going to go through. Again, this is only a 1-year research trial from what we know, but it does show a positive ROI over both a both a ground rig and a plane. Great data. I'd love to see more of that in the future. And let's see if there is, as we've actually invested in an agronomist. So in the next 12 months, we will have much more data coming out on not just products in different types of areas, but also drones versus other means of application. Sorry. So now I want to talk about the challenges of the spray drone industry. The number one challenge is government regulations. The FAA just announced that they are going to begin approving swarm exemptions. We've got a department that works on full-time compliance, and they walk everyone through all of that. But the FAA is trying to make compliance easier. They're not out here looking, they're not the sheriff out looking for somebody to quote unquote get with a speeding ticket or anything like that. They want everybody to be compliant and they want everybody to be safe, but they really aren't the enemy. The EPA, there's challenges with aerial labeling. Maybe someday they'll come out with a different aerial label for drones, but today, it's going to take time. One of the things that I would tell everybody, this gets asked a lot, can I spray chemicals through herbicide through my drone? Make sure it's labeled for aerial. Make sure it's labeled for aerial. The labels are there for a reason. Make sure that your insurance is covering it. Tank size relative to acreage. So a lot of people look at small tank size as a disadvantage. I look at it as an advantage because I can dump foliar feeds and biologicals into certain spots on the field without wasting the money on the high flats that are already going to make 300 bushels no matter what. Battery limitations. That is a challenge. That's the challenge to making these drones bigger, faster, more intuitive. The batteries are changing and they are developing, but those are today definitely some limitations. We would like to see the drone industry go back. This is contrary to what most are going to tell you. We would like to see it go back to a pressurized system, but in order to do that, we need much more powerful batteries. We think if we can go to a pressurized system, we can actually do a little bit more versatile work with herbicides. And then the other, again, I go back to the shameless plug, but most drone retailers don't locally service the drones they sell. All drones eventually crash, or I should say emergency land. No matter how you want to slice it, you're going to need parts and service. Make sure that that if and when you're ready to get into that business, that you partner with someone who is going to answer the phone on Saturdays and Sundays. With that said, again, my name's Danny Assman, and my company's called Terraplex Ag. Just a shameless little, like I said, where we have locations in Odebolt, Casey, and Pella, and we also have some more on the way. Thank you to Peoples for letting us do this.
Thank you, Danny. Pretty interesting stuff there. It'll be interesting to see how your service offerings evolve here in the future. We've gone a little bit long, so I'll probably just ask each speaker one question versus two, so we can get everybody, out of here at a little after 4:30. But I'll start with you, Brad. question is, what states have the top opportunities for renewable growth, and what states have the most restrictive renewable policies?
That's a great question. Illinois has the most opportunity for growth because, like it or not, the legislature took away local control. There's a bill being pushed through in Colorado right now that is likely to do the same thing if everybody on the Democrat side remains aligned. I think California has extraordinary potential too, because frankly, their grid's a wreck, and they need more generation, and they're not willing to utilize nuclear or coal. So, for me, California, Illinois, Colorado, those are all really interesting. Anecdotally, I just heard yesterday that North Dakota is fairly restrictive, South Dakota is fairly restrictive. So I would say those two are probably not ripe for meaningful development.
And I was only going to ask one question, but in how many states, real quick, how many states are you active in as far as your business?
Every state west of the Mississippi. I don't think I'm doing anything east of the Mississippi. Yeah.
Perfect. Okay, George. We got a question from the field here, but when purchasing an investment property with the intention of having it managed by a farm manager or locally managed afterwards, why should a landowner buy in the Delta versus the Midwest or Pacific Northwest or other geographic regions of the country?
Well, I think a lot of that, comes down to the owner preference. But if you're trying to one, aggregate acres or buy larger acres, the Delta's a perfect place to go. If you're also wanting to go somewhere where you got good quality water assets, because water will be the future of farming where we go, that's another thing to look at. And then you got a diversity of crops. I tease you and the other managers at PC that this year's not half corn and half beans, and the other year's half beans and half corn, because we can go rice, corn, cotton, wheat, beans, potatoes, peanuts. Like, we're going to have a lot of diversity, and I think that's continued to expand. So for the institutional players, it's a diversification play, and from an individual landowner standpoint, I think we can see higher returns, a little more risk, higher returns, and you can aggregate larger groups of land is what I've seen over the last 30 years.
Okay, again, I'm not holding true, but I got to follow up on that. In the Midwest, we have corn, soy. Down in the Delta, you have cotton, rice, corn, soy. As far as the management of those different crops, what would be the most, what requires the most management and then offers your clients the most return or opportunities for return?
Yeah, I would say, currently it's rice. Rice is the kingpin right now. Cotton is right up there, depending on your yields. So I would say cotton, rice. Corn has been, if you look back at some of my returns the last few years, corn has definitely been up there. When we took advantage of some of John's marketing opportunities, we were able to knock it out of the park. But currently it's rice and cotton are holding the key. And rice has been, while it took longer for the commodity price to get there above where our long-term average is, it's held relatively tight to where it's been, and it's providing the best opportunity right now.
Okay. Appreciate that. Again, moving on to John now, I'm surprised you don't have a number of questions down below. I've got, I think 20 or 25 myself that I'd like to ask you here, after we get off the call. But, my question for you is, how many years did it take to refine the algorithm to sell grain? Was this like an overnight deal, or did it take 20 years, of all your years in the business? How long did it take to refine that algorithm?
That happened relatively quickly. When we started following it, we found success. The problem is that we needed to add some additional pieces to it, and that's when we added the seasonality and the the cash flow, the flow of money, and the difference in the cash price, and that has helped us. But we're still looking for other pieces to add to that. So we're in hopes that we'll have another checkbox that'll give us a little bit more confidence. We need something that will allow us to get a sale off when the market's downtrending and expected to downtrend for longer. It's hard to get farmers to sell at any time. It's the price is never high enough, and then once it's been high and then it starts to go cheaper, then it's really hard to sell. And so we need a way of triggering sales in a declining market.
And this to recap, as far as, corn, soy, wheat, what is the biggest opportunity to conclude that you see for a rally in prices here in the next 3 to 4 months?
We need to have something that gets us started up to where we turn into an upward trend. And once we clear that green line, we think that'll be the first signal of it. Then we think the commodity funds, the spec funds, will be big buyers as they cover up a record short position. We think that's already started in wheat. We can see that in the graph. It hasn't yet started in corn and beans.
All right. Well, thank you, John. And then Danny, what do you see the largest opportunities for drone work in the ag space in the next 3 years, say, and then long term, what do you see the biggest opportunities in the drone world?
So the opportunities in the next 2-3 years are going to be, again, going back to that custom applicator, the farmer wanting to bring back the next generation of the family farm. Spray drones are continuing to advance, and as these spray drones advance, you're going to see not just the spray, but the payload. They'll begin to carry other types of payload back and forth and become transport style drones. I think what you're going to see is the imaging continuing to get better and better, and the data that farmers can get from the crops is going to, and how that ties back, whether that's to their ground sprayer or to an application drone or something else. I think it'll allow us to be much more precise. These drones are, I like to describe them as, we're in the iPhone 3 or 4 phase, not the iPhone. The difference between the one that I have today and the one I had 4 years ago seems like it's about the same, but in the beginning they were advancing quickly. We're still advancing quickly. So there are plenty of opportunities out there.
And then, maybe I missed this, but as far as your geographic region, landowner calls you in South Dakota or Illinois, like how big of a footprint can you guys service at Terraplex?
So we're across the state of Iowa. South Dakota is coming, and we've got partners in Oklahoma and Texas that we're also working with. So whether really, regardless of where you're at, either us or one of our partners can help you across the Midwest. It might not actually be Terraplex name on the invoice, or it might be, but the sales and the service will be behind it.
Well, perfect. Well, first of all, I want to thank all the speakers today. If anybody online has any questions or would like contact information for John or Brad or Danny or George, certainly reach out and we will put you in touch with them. If you're interested in any land management services, please email us at landmanagement@peoplescompany.com. And a copy of this video will be available for everyone tomorrow on the People's Company website. Again, thanks for everyone's time, and we will see you soon. Thank you.